In the fast-paced world of retail, even giants can stumble. Target is facing trouble this year, as a perfect storm of factors has sent shockwaves through the industry. With Target prices rising, a retail crisis looming, and both sales and profits dropping, investors are left wondering what's causing the Target stock decline. Join us as we unravel the key factors behind this unprecedented retail saga. In the vast landscape of American retail, Target, a household name, has found itself in a tough spot. Recent data paints a grim picture. In the past year alone, Target experienced an unprecedented 90% drop in profits. To counter these losses, the company tried to raise prices in 2023, but it backfired. Shoppers actually started to turn away as Target's inventory became less appealing due to higher prices. It's been over 2 decades since Target faced such a prolonged losing streak. Not even during the early 2000s, when financial markets were tumultuous, did Target suffer such severe losses as we've seen in 2022 and 2023. Let's paint the picture with some numbers for you. Last year, Target experienced losses in all 4 quarters. Profits plummeted by 49% in quarter 1, a staggering 90% in quarter 2, 54% in quarter 3, and another 52% in quarter 4. Despite offering deep discounts to clear excess inventory, Target saw a slump in sales, both in its physical stores and online. But what's at the heart of the problem? It's the merchandise in categories like clothing, accessories, and home goods that Target has always prided itself on. These categories make up more than 60% of Target's inventory. In simpler terms, the company lost 60% of its sales potential. This situation is causing concern among retail experts, even catching the attention of former Walmart CEO Bill Simon, who warned that retailers like Target are in deep trouble. The economic conditions of 2023 don't help either. Customers have tightened their purse strings amid a weakening broader economy. The stores selling non-essential items like Target are feeling the heat. Unfortunately, Target didn't have the right mix of inventory when this crisis hit. As consumers directed more of their budget toward groceries, home essentials, and sporting goods, Target's sales in these categories fell between 7% and 9% compared to the same period last year. Even though about 39% of Target's inventory is in the grocery category, it didn't see a significant increase in grocery sales in 2023. In fact, after meager increases of 1.7% and 0.8% in January and February, grocery sales declined by 0.7% in March and 0.9% in April. This led to an overall lackluster 0.9% uptick in food sales for the entire quarter. So let's break it down. Where did Target go wrong? It appears that Target might have taken a misstep in its pricing strategy. With an oversupply of discretionary items, the company decided to introduce new price increases in the only category where it remained profitable. However, customers didn't take these changes lightly. Over the span of a year, Target's overall grocery prices rose by a staggering 21%, according to data from Go Banking Rates. To put this into perspective, let's compare it to Walmart. Walmart increased its food prices by 27%, but this happened over 2.5 years, not just one. And even before the price hikes, Walmart's prices were lower than Target's. So you can see why customers weren't thrilled with Target's price increases. Before this, Target had already passed along higher operational costs to consumers in 2021 and 2022, putting additional strain on shoppers' wallets. We can see the impact of these price hikes in conversations happening on platforms like Reddit. One user shared their frustration, saying that prices at Target stores had become insane. They acknowledged that inflation was a factor, but it got particularly concerning when basic items from a year ago became unaffordable. For instance, they pointed out that a watermelon, which used to be priced at $3.99 during promotions, was now selling for $9.99 on some occasions. Customers also raised concerns about empty shelves in the grocery section, questionable quality of fruits and vegetables, and products disappearing from shelves with no return in sight. This paints a picture of a shopping experience that's not up to par with what customers expect. To make matters worse, competitors like Costco, Aldi, and Walmart are attracting Target's clientele. How? By offering more value and better deals for their customers. These stores have been able to maintain their appeal by keeping prices competitive and ensuring products are readily available. But here's where Target's strategy takes an interesting turn. Instead of focusing on meeting the needs of its current customer base, the company is actively trying to attract more households earning over $150,000 a year. In 2019, only 14.8% of its customers fell into this category. Today, that number has risen to 19.6%. While this may seem like a smart strategy, because these customers tend to spend more per sale, still, they aren't numerous enough to single-handedly resolve Target's financial woes. At times, it seems that Target may have forgotten its core identity as a mass retailer that should cater to consumers of all income levels. An example of this misalignment was its ill-fated holiday partnership with luxury department chain Neiman Marcus. The collaboration failed, mainly because Target priced the merchandise too high. Additionally, the ongoing issues with reliably stocking its stores with food and groceries have been a recurring problem. Non-discretionary categories, like food, should be their main focus as they drive repeat traffic because consumers always need to replenish their kitchens and pantries. The fact that Target isn't effectively addressing these issues indicates that the company is struggling to find a way out of its current predicament. Even the company's CEO and chairman, Brian Cornell, has acknowledged that their customers are feeling the pinch from the price increases of 2023. Now, let's talk about a big issue that's been affecting not only Target but also consumers across the country: inflation. Imagine trying to make ends meet when prices are rising stubbornly quarter after quarter. Many consumers find themselves carefully managing their budgets in the face of high inflation. With this constant price increase, people's purchasing power is dwindling and is getting tougher for them to make ends meet. To cope with these challenges, some consumers have been relying on borrowing money or dipping into their savings to make their weekly budgets work. However, for many, these options are starting to run out. As a result, shoppers have become increasingly sensitive to prices. They are paying more attention to promotions, trying to snag the best deals, and becoming more hesitant to buy items at full price. Currently, if Target wants to meet its modest sales forecast by 2023, it needs to boost sales during the back-to-school and holiday shopping seasons. However, investors and financial institutions are skeptical about the retailer's ability to achieve better results. Why? Experts like JP Morgan's analyst Christopher Hoover's voice their concerns, believing that consumers are facing increasing financial pressures. They're shifting their spending away from non-essential goods, which make up a significant portion of Target's sales. This shift could continue into the back-to-school season and linger during the holidays, potentially leading to negative traffic for Target. To add to the woe, after weaker-than-expected first-quarter results, JP Morgan downgraded Target's stock. This move triggered a massive sell-off, causing Target's shares to lose half their value since their peak. As per MarketWatch's data, things can't get much worse for the brand, right? Wrong. Target's CEO, Brian Cornell, predicts that organized retail crime will lead to a $500 million increase in stolen and lost merchandise this year. This adds to a growing issue of inventory shrinkage, which has been costing the company hundreds of millions of dollars more than in previous years. It's like a perfect storm of financial burden. All this makes financial analysts worry that Target's downfall might come sooner than expected. Douglas A. McIntyre, the co-founder, CEO, and editor-in-chief of 24/7 Wall Street, pointed out that Target has become the worst-performing retailer in America this year. While it might seem unfair to compare Target to smaller companies in the sector, given its size and sophistication, it should be performing much better. However, it's not. In fact, Target's most recent quarterly figures revealed that comparable store sales in the first 2 months of the second quarter were 4 times lower than in the same period last year. All financial indicators remain well below expectations. This situation is alarming because Target is such a beloved and popular retailer. However, the retail industry is unforgiving, and competitors are stepping up their game while Target faces these internal challenges. The fate of Target is uncertain, but what's clear is that something needs to change to prevent this beloved retailer from fading into history. With the current economic conditions, Target isn't the only retailer facing mounting problems. Click the video on screen now, where we reveal 15 big box retailers that are collapsing right before our eyes.